How fast can you really double your money in America? How long would it actually take you to turn $1,000 into $2,000 or $50,000 into $100,000? Most Americans don't know, and that's not because they're bad with money, it's because no one ever taught them how money actually multiplies. They put cash into a savings account, they see 0.5% or 1% interest, they feel safe, they feel responsible, and they assume that's just how wealth building works. But what if I told you that the difference between doubling your money in 6 to 7 years versus 60 to 70 years comes down to one simple formula you can calculate in less than 10 seconds? And what if I told you that millions of Americans right now are unknowingly choosing the 70-year path? By the end of this video, you'll understand exactly how long it takes to double your money, how to dramatically shorten that timeline, why inflation is silently stealing from you, and why mastering this one concept could determine whether you retire at 60 or work until 80. Before we go further, hit like, because this might be the most important financial lesson you learned this year. The mistake almost everyone makes. When people think about money, they focus on the wrong numbers. They ask, how much am I saving each month? What was my return last year? What's my bank balance today? But they rarely ask the real question, how fast is my money multiplying? There's a huge difference between growth and multiplication. Growth is when your account goes from $10,000 to $10,400. Multiplication is when it goes from $10,000 to $20,000. And the speed of that multiplication determines your entire financial future. A real American example. Let's take two people in the United States. Both start with $10,000. Person A puts it in a traditional savings account earning 1% annually, which is common at many US banks. Person B invests it in a low-cost S&P 500 index fund, which historically averages around 8 to 10% per year over the long term. Fast forward 10 years. Person A ends up with around $11,000. Person B ends up with over $25,000. Same starting point, same country, same time. Completely different outcome. And person B didn't do anything risky or magical. They simply understood how doubling time works. The 10-second formula that changes everything. There's a rule called the Rule of 72. Here's how it works. Take 72 and divide it by your annual return. That number tells you how many years it takes to double your money. If you earn 6%, 72 divided by 6 equals 12 years. 8%, 9 years. 10%, about 7 years. 12%, 6 years. 1%, 72 years. 72 years. That means if you rely only on a 1% savings account, your money might not even double once in your working lifetime. That's not safety, that's slow financial decay. The inflation trap in America. Here's where things get serious. Inflation in the US has averaged around 3% historically, and recently it has gone even higher in certain years. That means if your bank pays you 1%, but inflation is 3%, you're losing 2% in purchasing power every single year. Your account balance might look bigger, but what your money can buy is shrinking. Groceries cost more, rent costs more, healthcare costs more, college tuition keeps rising, insurance premiums increase. Everything creeps up. You're running on a treadmill thinking you're moving forward. That's why understanding real return matters. Real return equals return after inflation, fees, and taxes. If you earn 8%, lose 3% to inflation, and 2% to fees, your real return is only 3%. At 3%, it takes about 24 years to double your money. That's the difference between doubling 5 times in your lifetime or only once. The 3 forces that control your wealth. There are only 3 things that determine how fast you double your money: rate of return, time, and consistency. Most people obsess over return. They chase crypto spikes, they chase meme stocks, they chase get-rich-quick trends. But high return almost always means high risk. And if you double your money in 2 years but lose 80% the next year, you didn't build wealth, you gambled. Wealth is built through sustainable returns maintained over long periods. Historically, the US stock market has averaged around 10% annually over many decades. That means doubling roughly every 7 years. Let's visualize that. Start with $10,000. After 7 years, $20,000. After 14 years, $40,000. After 21 years, $80,000. After 28 years, $160,000. You didn't add more money. You just let compounding work. That's the part most people underestimate. Why most Americans never experience this? Because they quit too early. They invest for 3 years, the market dips, headlines scream recession, fear takes over. They sell. Every time you sell during a downturn, you reset the compounding clock. And compounding is not linear. It starts slow. It feels boring. The first doubling feels like it takes forever, but the later doublings are explosive. The last 10 years of compounding often create more wealth than the first 20 combined. But you only reach that phase if you stay in the game. Let me show you acceleration. Imagine you invest $5,000 at 10%. Year 1, $5,500. Year 2, $6,050. Year 3, $6,655. After 3 years, you've gained just over $1,600. It feels small, but keep going. Year 7, roughly $10,000. Year 14, $20,000. Year 21, $40,000. Year 28, $80,000. Each 7-year cycle gives you more than the previous cycle. That's acceleration. That's exponential growth. That's why patience is a financial superpower. How to shorten your doubling time. If you want to double faster, responsibly, here's how. First, increase return without increasing risk recklessly. Diversify intelligently. Stocks, index funds, real estate, retirement accounts like 401ks and IRAs, broad exposure. Second, minimize friction. Fees matter. If you pay 2% in management fees, you lose years of compounding. Low-cost index funds often charge 0.03% to 0.10%. That tiny difference can equal hundreds of thousands of dollars over decades. Third, contribute consistently. If you invest $500 per month at 10%, your compounding engine gets fuel from 2 directions: growth inside the account, new money entering. That combination dramatically reduces effective doubling time. The psychological war. The math is simple. Humans are not. The biggest obstacle to wealth isn't knowledge, it's emotion. When markets fall 20%, fear feels real. But downturns are normal. Markets rise, markets fall. Over long periods, markets trend upward. Every panic sale destroys years of potential growth. The wealthy don't avoid downturns, they survive them. That's the difference. Realistic doubling time in America. Here's what it actually looks like. 1%, 72 years. 5%, 14 years. 8%, 9 years. 10%, 7 years. 15%, 5 years. 20%, about 3 to 4 years. Extremely high risk. Yes, some entrepreneurs double money quickly. Yes, some traders hit massive gains. But for every one success story, dozens lose everything. For most Americans, a realistic, sustainable doubling range is 6 to 10 years. The power of multiple doublings. The real magic isn't doubling once, it's doubling repeatedly. Double once, 2x. Double twice, 4x. 3 times, 8x. 4 times, 16x. 5 times, 32x. 5 doublings turns $10,000 into $320,000. 3 doublings only gives you $80,000. That difference often comes down to just a few extra years of staying invested. The reality impact. Imagine 2 25-year-olds each invest $10,000. Person A earns 8%, doubling every 9 years. Person B earns 12%, doubling every 6 years. By 65, Person A ends around $200,000 plus. Person B approaches $1 million. Same start, same age, different doubling cycle. That's the power of shortening each cycle by just 3 years. Your action plan: calculate your true return. Eliminate unnecessary fees. Use tax-advantaged accounts when possible. Increase contributions gradually. Stay invested during downturns. Start immediately. Every year you delay is a lost year of compounding. Start at 25, you have 40 years. Start at 35, you have 30 years. That 10-year delay can cost hundreds of thousands. Final reality: doubling money isn't magic, it isn't luck, it isn't reserved for Wall Street insiders. It's math plus discipline. The rule of 72 works whether you start with $100 or $100,000. Find sustainable returns. Reduce friction. Stay consistent. Give it time. Eventually, what feels impossible becomes inevitable. Not because you did something extreme, but because you understood how money truly grows.